It's not every day that something like this happens, so if you're interested in Vanguard, global ETFs, or ESG funds, or even better, all three, then you're really going to want to hear this one. In this video, I'm going to be doing a deep dive into what this new Vanguard fund is, how it's different from the rest, who it's designed for, and then wrap up at the end with my thoughts. If you're a subscriber, then welcome back. I look forward to seeing you in the comment section below. But if you're new to my channel, then my name's Nick and I do videos all around investing and wealth creation. Let's dive into it then. What is this new Vanguard ETF all about? Well, it's actually the third in the trilogy, so a bit like Return of the King if you will. It goes by the name of the ESG Global All Cap Ucits ETF, so a bit of a mouthful, but it has the ticker symbol V3AM. This follows its previous two funds called the ESG Developed World All Cap Equity Index Fund and the ESG Emerging Markets All Cap Equity Index Fund. You might be sat there thinking, hang on, these sound eerily familiar to the Global All Cap, the Developed World All Cap and the Emerging Markets All Cap. Well, you are correct, and they're actually in fact extremely similar. But there's one key significant difference here. It's the mystical letters ESG. What on earth is that all about? Well, if you haven't heard of ESG before, it stands for Environmental, Social and Governance. This has emerged recently as investors are becoming increasingly interested in non-financial factors. So from one side, they're coming at investing with a more ethical standpoint. So basically, do they want to be investing in companies which are doing harm to the planet or doing good? However, from the other side of this, there has been a general moving consensus that anything that falls outside of the ESG guidelines has larger risks in the future and might actually have limited growth. Basically, they believe that ESG companies will perform better in the long term. There has been some research around ESG companies and their relative performance against non-ESG companies, which I will address shortly. Right, so now we understand that the underlying funds of the ESG Global All Cap is built off the Global All Cap. If you're interested in learning more about the Global All Cap, then I did a video comparing this fund against two other global ETFs. I'll put a banner somewhere above my shoulder here. So what is the material impact of ESG? How does this change the fund? Well, the index, being the Global All Cap, is screened for certain environmental, social and corporate governance criteria, which is actually done by somebody completely independent from Vanguard. They are looking to exclude any companies where its product or conduct has a negative impact on society and or its environment. I've actually taken the time to read through the criteria of what companies do not pass the ESG filter, so you don't have to. I can summarise this in four general categories. So these include 1. Companies which have had significant controversies as outlined by the United Nations in their 10 Principles of Global Compact. These 10 principles cover companies which have been in trouble for labour, human right or environmental or anti-corruption breaches. The second is any companies within the non-renewable energy space, so any companies which own reserves in coal, oil or gas. This does go further to cover any companies that primarily use these non-renewable energy sources. Surprisingly, this also includes any companies that generate revenues from nuclear power. 3. Any companies which produce vice products, which include adult entertainment, alcoholic beverages, tobacco companies, and any company providing a gambling service. And the final and fourth category, any companies which are involved in arms trade, so any company which is involved in the sale or manufacturing of weapons. So let's have a think about what sort of companies might be excluded then. The first one that comes to mind is BP or British Petroleum. They certainly won't make the list as they definitely own reserves in non-renewable energy. Hunting & Ingalls Industries, which is listed on the New York Stock Exchange, wouldn't make this cut as it's a nuclear power company. Philip Morris won't make it to this list either as they manufacture cigarettes. And then probably another one that you'll know well is William Hill. Obviously they won't make this list as they operate within the gambling industry. Each of these four companies are extremely profitable, but they wouldn't make the cut. There's a very good chance that you've used the product or services of at least one of these four companies, even if you didn't know about it. So now you know the sorts of companies that get excluded from this index. What basics do we need to know about the fund? Well, let's take a closer look at V3AM. It's currently priced at £3.61, so it's actually very handy as it has a very low share price. This means you're not going to have any issues with buying a whole share, well you shouldn't do anyway. Interestingly, the fund doesn't clarify how many stocks it holds at this time, which I do find a little bit odd. I'm not sure if it's due to the fund only going live very recently or there's something else, but don't fear though, I've actually had to think about how I could actually identify what companies are included in this fund, which I'll get round to shortly. Obviously, as it's a global ETF, the number will be very high, For my best guess, I'd imagine it's somewhere between 2,000 and 5,000 companies. It has an ongoing charge figure of 0.24%, which in the grand scheme of things is extremely low, but compared against other Vanguard funds, this is a tad on the high side, as you'd generally expect to be about 0.22, but there's barely any difference. It would make sense there would be additional management fees due to the need of screening companies for ESG and non-ESG. Further to this, its risk rating is 5 out of 7, which isn't a shock really, as it's fully invested in stocks and shares and no bonds, so I'd imagine it would be 5 out of 7. Its costs and minimums are the same as its other funds, so either a one-off payment of £500 to get started, or a monthly direct debit of £100. Now, let's look at the companies which are contained within this index to get a flavour of who appears and who doesn't. As said, there currently isn't a list of companies which are included within V3AM, but what we can do is we can look at the ESG Developed World All Cap, as this will make up the vast majority of the fund. After all, a global index should hold at least around 50% North America and 10 to 15% of other developed countries around the world, so logically speaking, at least 2/3 of this portfolio should contain companies from developed countries. If we look at the ESG Developed World All Cap, the top 10 companies includes absolute classics such as the FANG stocks, so Facebook, Apple, Amazon, Netflix and Google, but then it also includes other big hitters like JP Morgan, Tesla, Visa and Disney. But due to the subject matter of everything ESG, I've taken the time to go through all the top 500 companies within this index just to double check what sort of companies are getting through, as after all it's been filtered for all the ESG non-compliant companies, so I'm interested to see what companies actually squeak through. Here are my top 5 questionable companies or groups of companies that have made it through. The first one is Nestle. Really? How on earth has Nestle made it through this list? Nestle are considered one of the most hated companies in the world. There's probably only one or two that I think that might beat it. If you didn't know, they've been embroiled in a lot of controversies. Everything from child labour, unethical promotions, manipulating uneducated mothers, pollution, price fixing, mislabelings. You couldn't really make it up, there's loads of stuff. Feel free to do your own research online, but I think it's really laughable that they've made it through this filter. To be transparent though, I technically own Nestle as it's part of my global ETF, but I'm just surprised it passed this test. The second one that surprised me is Facebook. After the massive scandal around Cambridge Analytica, with them sharing loads of data with external companies and have actually swayed elections, I thought this was also interesting. The next was companies like Coca-Cola and McDonald's. Look, they don't conflict with any ESG standards that I can see, but I just wanted to highlight that they contribute really heavily to the obesity epidemic. I'm unsure how you can have a moral stance on other things, but you can overlook contributing factors of these two companies. Are they really any better than Philip Morris or William Hill? Next on the list is Uber. Uber has been in many court battles over the status of its drivers and the conditions that they work in. Everything from sick leave through to actually how much money they make per hour and the criticism that it might actually be under minimum wage. Again, very questionable. And lastly, you've got Honda and Ford. So let me get this right. BP can't be included, but companies that literally build machines to burn non-renewable sources can. I don't know. All I'm trying to demonstrate is it's extremely hard to draw a line when it comes to ESG, and we'll all have a different interpretation based on what is ethical and non-ethical. Personally, I find it a tough call to leave out companies like BP and then Nestle appearing on the list. At least there's a critical need for oil. Do we really need chocolate and baby formula? I don't know. This is only my personal viewpoint though, so I'll hand it over to you. What do you think? So aside from all this, who are ESG funds for? These funds are for individuals who have a more of an ethical stance when it comes to investing. So I think the fact that steps have been taken to provide such investment opportunities for certain investors I think is great. Vanguard are pretty late to this party because it has been around for a while, but at least they've got around to doing it now. I actually can think of one particular segment in the investing world who'd be really interested in this. If you look online, a very common question for online investors who happen to be Muslims is the following. Is X company investing halal or haram? For anyone who isn't aware of these terms, halal is the Arabic word for lawful or permitted, and the opposite being haram, which means forbidden. But what makes a certain investment halal or haram? From what I can tell, and believe me, I'm not an expert, there isn't a massively clear definition. I have seen different views from different Muslim scholars, so it seems like there is a bit of a grey area within it all. I'm not going to go into the detail here, but in a nutshell, I think ESG goes a long way in terms of moving Vanguard investments from haram to halal, so I think this is a massive positive. ESG isn't just an ethical argument though. Some investors point to the fact that ESG compliant companies perform better. I'll go into the research shortly, but the methodology goes something like this. Companies that fall within the ESG guidelines won't be negatively affected by government stepping in, stopping them from going from certain paths. So examples of this will be the tobacco industry, where there's actually been really heavy taxes put on tobacco products, which means they become far more expensive, which drives the sales down and also makes them less profitable. Then on the other hand, there's social pressures and public backlash. The best real life example I can think here was actually when I was at university 10 years ago, where my student union refused to list any Nestle products due to what I mentioned before, but specifically some of the issues they've had in Africa. This thought process makes sense though. Who would want to buy shares in a company which would be sailing so close to the edge of a new disaster? Think of the infamous BP disaster known as the Deepwater Horizon oil spill in 2010. Their share price fell nearly 50% in just 2 weeks following the event. To this date, they are still down 52% from the peak before the spill. So over 10 years later, the share price still hasn't recovered. But does the methodology stack up though with better returns? In short, yes. Since the emergence of ESG funds, there is clear data to show that ESG indexes outperform those that include non-ESG funds. The Financial Times Advisor showed research as recently as November 2020, which compared companies with a higher ESG rating outperforming lower ESG counterparts. As much as a 23% loss for firms that had a low ESG rating and 0.5% gain for ESG ratings that were high. This analysis was done over about 2,600 companies, so a fairly big data set. So the real question is, am I going to liquidate the funds I'm currently invested in, which has both ESG funds and non-ESG funds? Am I going to liquidate it and move it all over? Future Nick, can you add a drum roll somewhere, please, here? I am not. But you might be thinking, but Nick, all the data shows it outperforms, the methodology stacks up, why wouldn't you? You know what? It does. But let me give you some food for thought. I have a few issues with the data, which I can group into 3 criticisms or pushbacks. One is survivorship bias, the second is lack of data, and the third is a bit of a self-fulfilling prophecy. Let's start with survivorship bias. Some standards for ESG look backwards. It's clear to see if you're manufacturing weapons or alcoholic beverages that you're not going to include in ESG. But companies that might use child labour don't post this on the door of the companies. Companies who are wrongly tempted to do this or aren't aware that one of their contractors are doing this aren't going to shout about it. This means that companies within the ESG index could be a ticking time bomb waiting to happen without anybody being the wiser. It's easy to strip out companies with hindsight, so you're picking the data which suits your cause basically. Of course, stripping out BP after 2010 will make your data look better, as we all know what happened after it. But just because companies are within an ESG fund doesn't mean they're protected from some of the negatives. You might be still holding a company now that's about to hit the fan. Think of Enron, for example. The second issue that I have with ESG is they've got a very short history of performance. The majority will have performed extremely well recently, but they do hold a lot of tech, and tech does dodge a lot of the ESG filters. But they also don't include companies which have suffered due to the focus on climate change. All I'm trying to say is there's been a lot of favourable weather conditions for ESG funds recently, which has probably really boosted their performance. My last point on ESG funds, it's a bit of a self-fulfilling prophecy. If everyone is discussing ESG funds and talks about how great they are, then naturally the crowd is going to be drawn to them. My problem is how much of the ESG glow has already been priced in. My sense is actually there's been a lot of value already pumped into them, so actually investing now, you might be a bit too late to the party. How much upside realistically is there still? But the real question is, at what point does £1 worth of profit from Philip Morris become attractive? At what price to earnings ratio would get people to move from, say, an ESG company to someone like Philip Morris? All I'm trying to say is, at some point, people will move investments if they think they can get better return. The market always has a price. Personally, I think ESG is a bit like someone being on a very high horse. They think they're superior due to their notion of investing, but investing has never really been about moral decisions. It's been about identifying value. A bit like the ones who saw the ESG movement before it happened. They will have benefited greatly from this. For me, governance is what governments are for. Not for 1 second do I support profit over child labour or anything which falls outside the law. But this is basically creating a secondary framework to the law. There is a framework already in place to keep companies accountable. So if one of the companies which I invested into is found to use child labour, then the capital markets will react appropriately. Their share price will already drop through the floor. And that's what guides my decision making process, not a load of people gathering around the table to discuss who they like and don't like. Picking Honda and Nestle over Philip Morris and William Hill doesn't make a lot of sense to me. I don't understand what they're trying to prove. I could easily make bigger arguments on why Honda and Nestle are far bigger villains in this world. On top of this, don't you think these non-ESG companies are fully aware of their impacts on the world and doing stuff to try and get around it and benefit their value to society? Capitalism is the world's biggest version of a popularity contest. Don't you think these companies are doing everything they can to provide value to the world without taking it away? They might not have as clean a history as other companies, but surely they're more aware of the dangers than anyone else. To wrap up, if you're hearing about ESG now, then I think you're far too late to jump on the bandwagon. I understand the methodology around ESG, but it can't continue to outperform the market forever, because at some point the valuations of non-ESG companies is going to be too tempting compared to inflated ESG companies. If you're letting someone else picking your moral choices for you, then you most likely aren't that bothered. If you are that passionate about it and investing in what you believe in, then I think individual stock picking is probably better for you. Again, picking Nestle over William Hill based on Essex is problematic to say the least. Good luck defending that position. So what do you think of ESG investing? Is it something you already do, or is it something you're going to consider doing in the future? I really hope you've enjoyed this video on Vanguard's newest fund. I thought it was a really fun one to talk about. I hope you've learned something, but if you still have further questions or comments, then let me know in the comments below, because I do my very best to try and get back to you all. I do other videos in this channel around investing, finance and income growth. These include updates to my investment portfolios, which are primarily on Vanguard, but I do have other investment portfolios, such as my crypto portfolio on crypto.com, so feel free to check that out. That's all for this one. See you in the next one.